What's going on, everyone? Hey, Mark, how are you? Hey, everyone, how's it going? I'll go put it live here in the Facebook group, so 1 second. All right, now looks like we're live in Facebook. Hey, Mark, how are you?
Hey, doing well. How are you?
I'm very good. So I got, so you give it just a couple more minutes. There are people still filtering in here. We're also live in our Facebook group here as well, so yeah, we'll have. This will be recorded, everyone, so if you have to check out or something, that's fine. It'll be recorded. It'll be available the minute we're finished here. So I'm going to get started here. Guys, you know, in this group, we try to offer a lot of value. And although our group is mostly focused on selling on Amazon, we also branch off into a lot of other things related to Amazon, because that's just the beginning. There's a much broader picture we're trying to paint here. And one of the things is Q4 is over. A lot of you have maybe made money and have some extra cash on the side. And you probably wonder, okay, what do I do with it? Yeah, you could buy more inventory, but I think it's important you also consider other possible things to do with your money, which would be maybe invest it in something that you can guarantee some growth on your money, phenomenal growth, mind you. And we brought Mark on board here. He's our financial advisor. We met not too long ago. My other financial advisor had retired, and so we had decided to start up our new policy. And so Mark is going to be talking about this a little, kind of go in depth. And if you have questions, please, we'll get to them at the very end, and because I know there'll be plenty of questions. So as you see, he's posted there. So yeah, so I just want to kind of pass it on here to Mark, and please pay attention. Lots of questions. We'll get to them at the end. And just kind of and just another disclaimer, we get nothing from this. Ryan and I just want to provide you maximum value for this group. So I think that's what this group is all about. We're going to continue to add value to this group, tools and education, and this is just one of those things. So just please pay attention. If you have any questions, I will get to them at the end. I'll let you take it away.
All right, thanks, Danny. Appreciate it. Can you guys hear me?
No problem. Okay? I can hear you really good. Yeah.
Awesome. Yeah, I was just really honored and excited to get to chat with your team here, Danny. I think what you're doing and what you have done and what you guys are all doing as a mastermind is just spectacular. You take one look at the phenomenal growth of online businesses, Amazon profits, and so forth that you guys are able to put together and put your minds together on how to build the very best businesses you can. It's just phenomenal.
Let me add one thing, everyone. Mark Willis here, he is a certified financial planner. He is a #1 best-selling author, and he's the owner of Lake Growth Financial Services. It's a financial firm in Chicago, Illinois. Over the years, he has helped hundreds of clients to take back control of their financial future and, help build their businesses with sophisticated and their tax-efficient financial solutions, which is key. Everyone wants that. So he is a co-host on Not Your Average Financial Podcast, and he shares a lot of his strategies for investing in real estate, saving and paying for college without going broke, mind you, creating an income retirement that you can't outlive, and that's very important. A lot of people outlive their retirement, and that can be kind of scary. So, Mark works with people, who want to grow their wealth in ways that are safe and predictable and become their own source of financing. He'll help you create tax-free income in retirement, which that's huge. That's almost unheard of. So, just help join me in giving him a warm welcome. So I'll without further ado, we'll let Mark get here, start his presentation.
Thanks. Appreciate it, Danny. Yeah, I'd love to be as brief as I can, and there's a lot of ground I'd love to cover. But really, again, Danny, really appreciate the opportunity to speak. Let me see if I can share my computer screen with you guys so I can right into the presentation. Let's see if I do this one. I'm going to hit share.
Yeah.
Screen. Okay. All right. Let me see if I can pull up my slideshow here. Okay. Can you guys see that?
It's cute.
Oh, thanks.
I love it.
She's having even more fun than we will right now.
Yeah, exactly.
But I've got the screen up. Hopefully you guys can see that okay.
Yep, they can all see it. So
okay.
Looks good.
Right on. Let's dive right on in. So how to cut out banks, credit cards, and finance companies and let your business be its own source of financing. So, when you earn profit from your business, what do you do with it? At the end of the month, let's say you had $1, you have a choice. That's discretionary income. You can spend it, or you can reinvest it in your business, or of course you can just put it in a 401k or a KEO or a Simple or some other SEP IRA. What you do with your money matters. So that's what we'd like to get into a little bit together today. Danny, thank you for that introduction. Appreciate it, man. And so I'll just skip over this part. Let me get right to it, guys. A banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back the minute it begins to rain. Who said it? And Danny, I don't know if you can still see the chat box or not, but anybody have any first person to get it right, I'll send a prize to. So anybody have any guesses on?
Guys.
Yeah, anybody have any ideas there? Mark Twain?
Yep.
All right.
J.C. Penney, Mark Twain was the first answer we got.
Okay, letter D. Who said letter D first?
That was, John Kane. John Kane won.
Okay, I'm writing your name down, Mr. John. You were correct. And maybe Danny, you and I can connect afterwards to figure out.
Yeah, definitely.
John Kane. Better write that down. Way to go. Yeah, that's isn't that absolutely the truth? I mean, not much has changed really since Mark Twain wrote that quote 100 years ago. Banks have historically large amounts of capital. They're still not lending out to folks, even after 10 years after the Great Recession started.
Yes.
I mean, guys, they were given $1 trillion by our government. That means you and me, since we are the people, by the people, for the people. We gave the banks $1 trillion. And when you and I walk into a bank for a business loan or a line of credit, just try it and see how easy it is to get that money back.
Exactly.
Right? So that can mean the death of many small businesses. If cash flow is the oxygen that keeps our businesses alive. And if you can't access cash, that can mean the death of your business. That means 9 out of 10 folks, 9 out of 10 businesses don't survive their first year. Is that quote we all hear rolling around. So I'd like to maybe posit here, guys, that it's the banks that are the ones that are possibly the biggest causes of small business ruin, right? And even if you can get a bank loan, what happens next? You're stuck with payments that leach those competitive edges away from your business. We'll look at exactly what that does to a business when all they have is basically a paycheck going from their customers to themselves and then directly to the bank. right? Danny, any thoughts on that?
I completely agree with that. Yeah, it's especially in our business, Amazon, that's all about cash flows. And a lot of times you're just trying to figure out, oh my gosh, how do I pay my credit card bill? I got this inventory that didn't sell, and I got this bill or this invoice I need to pay, or my credit card bill I need to pay. And a lot of people worry about that. I know that's a very common struggle.
Right.
And it'd be nice to not have to worry about that anymore. Like you said, being your own quote unquote bank.
Yep. You know, so I've seen probably in my years as a financial advisor three central things that I believe are not just for business owners, but just for people in general. You know, really, no matter what state you live in, what country you live in, this seems to be the trend. If you follow the news, if you keep an eye on the trends that people have been taking over the last 60 years, really, the three issues that I hear most often when I meet with clients is they are wrapped up in debt, they're speculating, and lifestyle is you know, eating away at their wealth. So let's look at each one in turn. The average American business owner, one more pop quiz here, guys. Anybody have a guess? First person, we'll give you a minute or so to answer. For a person who gets the closest answer correct, I'll send another one of our books to. The average American business owner spends what percent of total gross revenues on financing? So average American business owner spends what percentage of total gross revenues on financing? Any guesses?
So we got 75, 60, 70, 67, 88, 80.
Wow. Okay. So if I make $10 this month, some people are thinking we might be spending 7 or 8 of those dollars on credit cards and that sort of thing.
Yes. We have.
Wow.
We
I've
have
got a list of everything here.
We have 18, 10, 45, 75, 50, goes all over the place.
Wow.
Lots of guesses.
I wonder why the difference is. Anybody have, so on this list here, this kind of includes everything from credit cards to venture capital, business loans, car financing, everything. Okay. Wow. Somebody wrote 100% goes to the banks. Wow. Anybody in the 30s, like mid 30s? I see a 30% here by Chelsea.
Yes, we have a 35 by Archie's got 35, 20 Dave, and 30 from Chelsea. Yeah.
All right.
30.
Archie, you got it right on the nose. It's 35.5%.
All right.
So way to go. I'm writing your name down too. We'll get you one of my best-selling books or any other book you'd like of the list. I'll show you guys. But yeah, way to go. 35.5%. That means
that's crazy.
A third of our day, Danny, is going to the bank, basically.
That doesn't even include taxes.
Yeah. Well, yeah, true. Yeah. So when you add taxes to the mix, that's half our day is basically slaves to somebody else.
Oh man.
Now who's taking that, right?
Yeah.
I mean, if I get a business loan, how much risk is the bank really taking?
Well, the way they have it structured, it seems almost zero.
Yep. So exactly right. They underwrite, they figure it out, they back test, they know law of averages. You know, they can effectively make sure that they only give loans to people who are going to pay them back. How much risk are we taking when we ask for that loan? You know, when we set out to start our business, that's not a risk-free venture, right?
No, not at all. All the risk.
Yeah. Last question here, then we'll dive into some more content. Americans save, again, what percentage of their income? First person to get it right, we're sending the book out to you. Americans
5,
save
10, 2, 5. Those seem like good numbers. 20, 2, 8, 1, 5, 6, 14, 20, 25, 13.
Wow.
They're about pretty close. Yeah.
Love it. Love it. Who said 5 first?
Let's see. That was, let me check. That we have Sailor.
All right. Sailor. All right. Yep. Sailor, I'm writing your name down. Way to go. It's 4.9 as of the last recording I found. So let's get to it. Actually, it's right up on our screen now. If you guys can see this now, in 1940, if we made $1 in 1940, this is how we would spend it: 11% to debt, 15% taxes, 47% lifestyle. So we were only living on half of our earnings back then, and we were able to save 30% of our income according to the U.S. Department of Commerce Bureau.
Wow.
Now in 2015, the numbers have significantly swapped. Let's take a look at what's going on here. So same thing with, basically what happened, guys, was our savings and our debt flip-flopped for the most part. Everything else is not far off. Funny enough, we think we're in higher taxes than we were in the 40s, but actually we're about this, not far from the same.
Yes.
But look at what happened to our savings. Isn't that pathetic? And our debt, we're actually outsourcing our lifestyle to our future selves, right?
Exactly.
Danny, any thoughts or comments on this?
I gotta say, I was kind of familiar with that, but man, that is shocking. But no surprise, because I can say I was well within, my savings were probably at 0%, and for a while, and taxes, debt were probably 80% of that lifestyle, maybe 20%, because we were so broke. So, and I think everyone's kind of been in the same boat at one point or another. So
we are a cash-strapped nation. I feel like we almost don't even need these statistics, but
yes,
we've got 401ks that are maxed out, loaned out to the max, credit cards that are maxed out. We got lines of credit against our homes. Sounds like 2008 all over again.
Yes.
So I've got a loan up here. This is just a standard issue, flat, fixed payment loan. Any business line of credit would look something like this. Over 48 months, maybe you take a $50,000 loan. And that's going to mean you're going to have to cough up $1,200 a month at 10% to pay that loan back. And now, what if you miss a couple payments? How's the bank going to take that?
Get overdue fees.
Right. Yep.
Yeah.
Miss too many payments, they might repossess the inventory or come after your car or whatever else, right?
Exactly.
So
the banks love it. You're right, Christine. The banks love it when you don't overdraft or late payment fees. They love that stuff.
It's true. They get a sick pleasure out of calling us at dinner time or dinging our credit score or repoing our inventory or our cars or whatever it is. And again, they get the privilege for the privilege of being in debt to them. We're going to have to cough up an extra $10,800 over the course of the 48 months. Now, one more thing. If I bought let's say it was a piece of capital expenditure like a farm equipment or some other business equipment or any kind of loan against property that's depreciating in value, by the time our 48 months are up, guys, we got to go buy another piece of equipment or more inventory. So, we didn't have a chance to save any money to do that. So we just basically stay on this cycle over and over and over again. We just wash, rinse, repeat, right? Is that kind of feeling true? So we've got to find a way off this treadmill. Otherwise, banks will keep reaping all the profits off your hard labor in your business. Now, most people do put something away, like we said, about 5% on average, but where do we put it? Well, since we can't save as much, here's kind of I don't know if this is just in the back of most people's minds, but when I meet with many people, I sort of hear this sentence in the background, that almost a belief that they're not ready to say out loud, but this is sort of what they're telling me as a financial planner. They walk in, they sit down, we have a conversation about what they can or cannot save, and then they say something like this. Well, Mark, I'll just save less because I'll put more at risk and my rate of return will be higher. And that's actually been the statement that Americans have been saying to ourselves for the last 50, 60 years as we've moved from guaranteed ways of saving and into speculation, like the stock market. And that's when we created, as a culture, we created all the things that you see on the screen here. I mean, anyone, I guess I'm asking one more question here, but anybody have any guesses on when the first 401k was issued?
Good question.
I'll give you a clue. It was not on the first day of creation. It's a little younger than that.
1934.
Okay.
83, 1950, 1929, 2002, 78.
All right. People are probably having enough time to Google it at this point. I think it's I thought it was 1981. I'll have to double check that one. So let me get back to you on that one. But yeah, not that long ago. Some people are probably old enough to remember when it got started. So 401ks are not, they weren't, built right into the Constitution of the United States, that's for sure.
Exactly.
So you add it all up, guys. There's 34.5% to banks, 5% to you. Who do you think is going to win in that game?
Obviously, the bank.
Yeah, yeah.
Mhm.
So let's talk about, well, maybe the better route is rather than going to banks and credit cards and finance companies, maybe we'll just pay cash for everything. A lot of folks that I work with say that that's the way to go. And that's actually, we all need cash to survive, but the truth
Mhm.
is, and this is very important that our listeners hear this, like you finance everything you buy. Let that sink in for a moment. Either
Oh,
you pay interest to a bank, or you pass up interest you could have earned on your money had you left it invested instead.
it's a good point. Very good point.
So let me draw this because I think this bears a little bit of repeating. Let's say again that we're at net zero here. This line represents net zero. And let's say we need to buy some inventory for our business, or shoot, just buy a car or whatever else we might need. And now we're below net zero, right? Now we owe somebody something. If
Mhm.
we don't have money saved in the bank, we're gonna have to go and get a loan. And then every 30 days for the next 5 years, we're gonna be making those payments. And when we get to this point here, this little moment, I don't know if you can see my mouse, but at the
Yep.
moment we get back up to net zero, we're screaming, I'm debt free, right? I'm debt free.
Yeah.
And then we're back at like we've got a 5-year-old car and the kids need a bigger back seat and whatever else, and now we got to
Uh-huh.
go do it all over again, right?
Yep.
And this is kind of the treadmill that most Americans stay on.
You're right.
Now the other way to go is to save. So take the bus for 4 or 5 years, and slowly but surely we save money in our bank accounts, our regular savings account. And at that point, when we get to this point here, we've saved 30 grand or whatever for the vehicle. But now we've got to take money out of the bank. And Danny, pop quiz here. How much interest do you earn on money you've withdrawn from your bank?
You would get essentially what, a negative interest, right?
Wow. Hey, yeah. Say more about that. What do you mean?
Well, if you take the money out, you take 10,000 of that 30,000 out, then you're losing out on the interest on that 10,000 you withdrew. So you're actually getting like a negative percentage rate on your money.
Wow. Yeah. Smart. You're exactly right. I mean, the true technical answer is 0%, right? Once you take
Yeah.
money out, you're no longer earning any interest. But you've got the long range view in mind, Danny. You've got the
Mm-hmm.
idea that this is supposed to continue to grow. Every dollar I spend is gone forever, but also gone is all the money that $1 could have grown to had I left it invested and not spent.
Yes,
It's very,
exactly.
very true. And again, now we've broken compound interest, and we got to start all the way over, climbing up that
Mm-hmm.
mountain again, only to crash every time we buy. So even paying cash is not the answer.
No.
So what I'd like to suggest is that we do something like this. We lift off from zero, that nice J curve there,
Mm-hmm.
to true wealth, and we become our own banker. We borrow against ourselves. How do we do that?
Precisely.
So it would look something like this, right? We're borrowing and we're paying ourselves back even as the money continues to build and grow.
Love that visual. That's awesome. I like that.
Thanks. Yeah, I think it just needs to be as simple as possible because we've really been taught a lot of things by the banks. Obviously, they've got a vested interest in us using their money.
Mm-hmm.
Somebody once said, "Watch how banks use their money. Don't do what they tell you to do with your."
Yeah, that's a good point.
So, and they're not keeping that money in the vault, are they?
No way.
Anyone? Oh, go ahead. Go ahead.
As I say, at best, they may keep 5% of the actual depositor's money on hand at any given time.
Crazy. Absolutely crazy. You're exactly right. If I go in and I deposit $1,000, they're going to keep, a very small percentage, somewhere between 5 and 10%, just for FDIC insurance backing. So if
Mm-hmm.
all of us ran on the banks, only 1 in 10 of us could get the money out.
Yep.
Yeah. So let's take a look here at. So if I just paid cash for my cars, and let's say I went on some business trips or vacations. Let's say I bought 8 cars over my lifetime, went on 12 business trips or vacations. That would just the raw cost would be $260,000 over my lifetime.
Mm-hmm.
And that would be meaning I would have to save $361 a month in my normal checking or savings account to get there.
Yeah.
Right? All right. So financing those with a bank loan or a credit card would mean a lifetime of payments that I'm not flexible on, right? They'll repo my car if I don't pay those loans off, or my inventory or whatever. And that total cost at 10% would be $365,000. So an extra 100 grand just for the privilege of being in debt to somebody else.
Mm-hmm.
Now, even paying cash, let's say that 260,000 bucks that we paid cash for, if we hadn't bought the cars, if we hadn't gone on vacation, that idea there is, instead of spending the money, if we'd invested it and not touched it over 5 years at 5%, or over 60 years at 5%, would be $1.5 million. I got my pinky finger on my lip here. So I hope you liked your vacation.
Yeah.
Right. So if you could design the perfect financial instrument, now here's kind of something I'd love to again get folks' feedback on our chat. If you could design the perfect financial instrument, let's just pretend for a minute we're Janet Yellen or we're Pope of Money for the day or something, and we can just create the next 401k or the next brokerage account, or what would, for building your businesses, everybody, what would be some important characteristics? Let's just create the unicorn financial vehicle out there. What would you want your money to do for you?
Someone put definitely easy to understand by a non-accountant. That's a good point.
Yes, well
That's
said.
good. Never depend on loans and banks, of course.
Mm-hmm.
Continuing to grow, exactly. Pays out passive income while continuing to grow. Earn interest, absolutely. You get no interest now. 200% minimum ROI.
I love that, Christine. That's great. Perfect.
Yeah, just earns interest. I mean, it's pretty sad that we just say that, yeah.
Sweet. Yeah, I saw passive income, like you mentioned, and continuing to grow as you take the money out, never being dependent. Boy, these are great, guys. Great. One or two others? Any other quick thoughts? Again, it could be anything. I like the idea of it being simple and easy to understand by the non-accountants. That's a great one.
Easy to access your funds. I think that would be a great thing.
Yeah, absolutely.
It's your money. Why can't you just access it? Why is it so hard to access your own funds?
Well said. Yeah, what's that? 401ks, for example, have those early withdrawal penalties. You got to.
Oh gosh, that's just a nightmare. Yeah.
Yep.
Yeah, easy access and no penalties. Absolutely, Kate.
Well said.
Exactly.
Let me throw a list on that I put together before this meeting. So here's a quick list. I've got 1 or 2 slides of this. So I agree with you guys. I think immediate access to my money for any reason. I don't need to have prohibited transactions like IRAs typically have or 401ks typically have. I want safety, something that's going to be, third-party regulated, meaning, it's not some fly-by-night Bernie Madoff or Enron scheme. I want to make sure that there's third parties looking at this to make sure that it's financially solvent. I want some guarantees on the principal, meaning I want my money there when I go to look for it, like a shoebox. At least it has guarantees on my principal, unless my kids are around.
Yep.
Guarantees on my growth, like someone said. We want some good competitive rates of return on that money that's predictable. I want it to be tax deferred as it grows, and I want it to be tax free when I spend it.
Absolutely. Yes, that's a big one.
I'm just creating my unicorn here. I mean, this is my wish list. I don't want it to be limiting me. So Roth IRAs are pretty cool because they do exactly that. They're tax deferred accumulation. They're tax free income in retirement. But we've got a real severe limit on how much we can put into Roth IRAs. If you're 50 years old, you get a whopping $6,000 a year that you can chunk into a Roth IRA. That's not going to solve our retirement crisis, that's for sure. I want it to be flexible. I want it to be tax-free to my heirs. I want it to be outside of probate, and I want it to be outside of bankruptcy. If I happen to go through a bankruptcy or any other creditor, court cases or whatever, and I want it to have a specific sell price. If I ever decide to sell my business to my partner, I'd want it to have a guaranteed locked-in price. So, does anybody have any idea? I mean, I guess this is an awesome list, but does it really matter unless something like this actually exists? And the answer is yes, it does. Yep. Something like this does exist. So I put together just a very quick checklist of about 12 different places, different financial products that exist out there with all the little lists that I just read off to you guys, and put little check marks next to everything, that I felt like was most relevant. So like, cash just in your pocket, that's predictable. Hopefully it's still there when you go to look for it. but it's not really a competitive rate of return, right? It's just going to sit there, soak and sour in your shoebox or whatever. So we've got checking and savings, CDs, bond funds. You know, you can kind of read down the list. Again, we are going to record this, so thank you, Danny, for that, by the way.
No problem.
Folks can look this over. I went through, and as part of my certified financial planner training and studies, which took several years, they put you through the ringer. They introduce you to about 450 financial products that exist in the universe out there, and several thousand different ways to use those products.
Wow.
You know, so you can combine them all together in multiple ways. You know, a brokerage account and gold can be combined for a specific strategy, for example, or real estate and, you know, mutual funds can be combined for, you know, real estate investment trusts, for example. So we could talk about all those things or none of those things, but if we're trying to build the very best business you guys can build, where's the best place to keep your money? And so I've got the second sheet here, and it goes common stock, equity mutual funds, variable annuities. You can read down the list. One of the things that really checked all the boxes for me as I was reading through it was something called participating whole life insurance. So that's what I'd like to spend some time talking about for the remainder of our time, and then get your questions too. So again, we could go on. Revocable trusts, self-directed IRAs, puts and calls, bank loans. If I could find anything else that would best fit our solutions that we're trying to do for our business, I'd be talking about that. But there is a specific strategy I call Bank on Yourself that meets a lot of the things that we've all been talking about on the chat and on this call. So it's not a good fit for everybody, but it may be something that you at least need to know about to help grow and add value to your business. So Bank on Yourself, again, that's just a nickname for a very old form of dividend-paying whole life insurance, something that's increased in value, guaranteed every single year for the last 160 years. All right, so it's a method used by hundreds of thousands of Americans. Not one of them lost a penny the last time the market crashed. It's also, it uses a guaranteed formula to grow your savings predictably every single year, even when stocks and real estate markets are tumbling. It's a way to open a line of credit to your business, whatever your line of credit needs are, 500,000, a million or more, without increasing any risk to your business. Okay, so it's something that, again, has increased every year for the last 160 years, and it's something that business owners like Walt Disney, J.C. Penney, Ray Kroc, Doris Christopher, others have used to help grow their businesses. It does provide a guaranteed, predictable retirement income whenever you need it. You could be, you know, 59 and a half or 39 and a half and start taking a retirement income off your Bank on Yourself plan. So it is tax-free as long as it's existed the last 160 years. It has remained and is still totally accessible, tax-free. And it lets you bypass banks and credit card companies to become your own banker, to become your own source of financing. Okay, so wow, that's pretty cool. Mark, what's the downside? What's the catch? Well, as transparently as I can, again, this is still in the real world here. It does take a few years for your cash value, the money you've put in there, to catch up to your contributions, because it is insurance. We're buying life insurance designed for maximum cash accumulation. So that's news to a lot of people. So I'll just briefly mention, hey, term insurance is different than this type of policy. So most people know of term insurance, and that's sort of like renting. But what we're discussing here is owning your life insurance, not renting it. So term insurance expires after a certain period of time. Whole life insurance is there for you forever, kind of like your home, and you can use the equity in your home for things. You know, whether it's, you know, investing in your property, adding that second bedroom. You can do the same thing with the cash value of your life insurance policy. Danny, any thoughts or quick comments on anything so far?
Let's see. Nope, I don't think so. Yeah, it's
cool.
Yeah.
Cool. So it's steady returns. That can be a good thing for a lot of folks, but it could be a down thing too for somebody who's looking for quick rate of return, quick fix. You know, 30% this year. You'll never get that with these policies. It's just slow and steady wins the race. And also, you still have to save the money in it. You know, we're not able to, you know, put a few pennies in and then go loan out millions of dollars. You know, that's back to regular banks. You know, so
yeah.
Here's a picture, and apologies for the background on this slide. I thought maybe I'd put it on white background, but anyway, you can kind of see the picture here. Here's a guy who started tracking his net worth back in 1999, and here's the tech bubble. Here's the paper losses and the paper gains, and he's barely cracking I mean, he's really hardly growing his net worth over the long haul at all until he opens his first Bank on Yourself policy. And so even during a very weak recovery, those years after the financial crisis, he's really locking in his gains every single year. So he actually increased his net worth 86% in just 3.5 years. So I think this picture speaks 1,000 words. We can either ride that roller coaster and maybe just beat inflation, or we can pack in real wealth and begin to use this for your financial future. All right, so let's see what one of these things really looks like. So again, most people tell me, well, Mark, I've heard of whole life insurance. It grows too slowly. That's one of the things I hear people say.
Absolutely.
So I went ahead and laid out side by side an old-fashioned, generic whole life insurance policy that really was designed for the death benefit. And then policy number 2 is really designed for maximum cash value. Now, I won't get into all the design features. We just don't have time to. I'd be happy to if we have time at the end.
Sure.
But this is a guy who's 35 years old, and he's putting $1,000 a month into the plan. So that means $12,000 a year. So again, don't pay attention to age or amounts. These numbers were just custom tailored for this guy's situation. You guys would have your own numbers, in your specific personal situation. But here's the first policy. Starting in year 1, he's got dumped in 12 grand, and he's got a death benefit of almost $700,000. But his cash value is a meager $1,100.
Yes.
So where did all that money go?
Yep.
Right? Danny, any guesses on that?
Well, went to fund all of your death benefit, I'm guessing.
Mm-hmm. Yep. It's supporting that very expensive liability to the insurance company there. That's 700 grand they got to chunk out to your family. So, and it goes to the insurance agent, by the way, too. That's a nice, cool 11 grand that he made that year.
Yep.
So the way these policies would work for someone who is really designing this for death benefit, it looks something like this. On the other hand, if we're using this for a business management tool, financial management tool for your businesses, place to stash your cash once you've earned some profits in your businesses, it would look something better like this. Maybe I think squeezing down that death benefit as much as possible to almost half of what it was with policy 1 lets you have 8 times as much cash value in the first year alone.
Yes. Yeah.
And that's $8,500 you can use to finance some inventory, or pay your taxes, or take the next business trip to go to Vegas or wherever else you might want to go, right?
Yep.
And as the years go on, do you ever see these numbers shrink, Danny, or are they always growing?
No, they never shrink.
It's awesome, right? Here's 20 years later. I'm just kind of zipping forward in time here. So he's got more cash in his policy number 2 than in policy number 1 for the rest of his life. He's got 1.1 million bucks in the policy there year 40. I think it's kind of cool. By year 30, for example, he's still throwing in that 12 grand or 1,000 bucks a month, but now it's doing basically 3 times his contributions each year of growth. This is how much it grew in just 1 year. And he's got access to 600 grand, 672,000 bucks for retirement if you wanted to use it at that time.
That's crazy.
It's awesome. All right, so guys, it's the old Will Rogers quote, the problem in America isn't what people don't know, the problem is what people think they know that just ain't so.
Yes.
I was stuck in this. I grew up and was trained as a certified financial planner to just not see the value in whole life insurance for the business owner. And I really believe that it has its place, it should have its place in your portfolio as you're helping to grow your business. So J.C. Penney in the Great Depression, what's his name, James Penney, took a loan from his life insurance to cover payroll when everybody else was having to lay everyone off. Walt Disney, he went to like 100 banks and nobody would lend him money for Disneyland. Yeah. So he borrowed from his life insurance to get the construction started. Ray Kroc, he was the guy that invested in McDonald's, and got that franchising model going. If you are a part of a franchise, you can thank him because he basically started it all those years ago, and he used a life insurance loan to help get the marketing for McDonald's going. Doris Christopher had a life insurance policy with just $2,000 in it. And she borrowed from that to start the Pampered Chef. And later let's see, yeah, I wrote down here in 2002, Doris Christopher sold her kitchen tool company, the Pampered Chef, to Warren Buffett for $1.5 billion with a B billion dollars.
Wow.
And yeah, she had just borrowed $2 or $3 grand from her life insurance back in the 80s to get the business started. I love that.
Yes.
Any quick questions, comments?
There's a couple of questions, but I guess we can save them until the end.
Good idea. Good idea. Yeah. All right. So you're already in 2 businesses. That's the truth. Think about it. You're already in the banking business. You're already involved in the banking industry. Why not be your own banker? Right? You're not just in the Amazon business or whatever else you do for work. You're also in the banking business. And let's sit on the right side of the banker's desk and begin to take advantage of that strategy that banks already use. So if you could be your own banker, you can borrow 85 to 90% of your cash from your policy, set up a repayment plan, by the way, to yourself that's designed by you. So you get to set up and decide what your repayment is on these loans. You take out a loan, you don't want to pay it back right away. Nobody's going to force you to. It's your money. And by the way, your money continues to earn the same interest and dividends even on the capital you borrow.
That's huge.
Let's just say that again, because again, it's so important that people catch this. Remember opportunity cost, that little drawing with the staircases and the trouble with paying cash is we no longer earn interest on money we spent yesterday. But here's an opportunity to borrow from your policy with interest rates well below market rates, and your money in your policy continues to earn you interest and dividends even on the capital you borrow. So when you bank on yourself, your money continues growing as if you never touched a dime of it.
Let me put that in layman's terms for you. So for an Amazon seller, say you had a cash value of your policy of $50,000. You could take $40,000 out during Q4, buy inventory with it. That $40,000 will continue to earn a very high interest rate, way higher than anything you can get anywhere else. And all the while, you're using that money to buy inventory and grow that $40,000 because you're obviously buying stuff that you buy low and sell high. So you're earning essentially interest on that money as well. Now you're paying yourself back just like you would pay a bank, but you're paying yourself back, hey, what, $400 a month. And you can pay back as quickly as you want or a little bit at a time, and it just keeps earning interest as if you never have taken that $40,000 out. So just kind of put it in Amazon terms for you.
Well said.
The same interest, yeah, Christine, the same interest as the principal. So if you had $50,000 out, yeah, you would still be earning interest on $50,000, no matter if you took $40,000 of that out. So
yep.
A huge point.
Yep. If you had spent that money in cash, it'd be gone forever. This is a way to let your money essentially do 2 things at once. Now, a lot of people get off the roller coaster at this point. They say, well, wait a minute, that sounds.
We already got a couple. Yeah.
For the nerds, okay, good. And by the way, that took me 7 months to get to this point where I saw this for what it was, guys. So don't feel like you need to get this right away. But what I decided was on the next couple of slides, I wanted to show you guys a real policy taking a real loan and how these policies continue to grow even on the capital you borrow. So I don't know how to make this any more transparent than I can on the next couple of slides. So
yeah, pay attention, guys.
So this is as real as it gets. This is an actual policy for a guy who's 45 years old. And again, numbers are proportional, so your numbers might look very different than his. But in this case, he was able to comfortably set aside $32,000 a year, a little less than $3 grand a month. But again, numbers are his numbers. You would just adjust to yours. And if you can see all these numbers, I know it's a mess of numbers on the screen, but in the first 10 years, he makes a normal, regular payment to the policy. And then if you can see it right here in year 11, he stops funding it completely. No more payments ever do.
Absolutely.
Right?
Yeah.
Now over here is the cash value, and over here is his death benefit. Almost all the other numbers on the screen don't matter. Happy to explain any of them to you, but the surrender value is his cash value. That's the money he can spend or use for his business. So in the first few years, notice there's a little bit of an insurance cost there.
Mm-hmm.
And if you notice, by year 10, he's got almost $400,000 in tax-free money he could spend any way he wanted to. Pretty cool. Now, I wanted to make sure everybody paid close attention to the dividends, because those will matter when we get to the next couple slides. Okay? All right, so in the next slide, this is the same policy, but now he's decided to take a loan for $350,000. 350 grand. What could you do with your business?
Wow.
350 grand, right?
Mm-hmm.
He could have taken a loan any year he wanted, year 1, year 5, but he waited until year 11 in this case. He borrows out $350,000, and notice what the dividend is there.
Mm-hmm.
Exactly what it was without the loan, right?
Yep.
Now, he can't borrow against the same dollar twice.
No.
If he borrowed 350 grand in year 11, he can only use the remaining 50 grand that's left.
Yes.
He didn't collateralize. And guys, this is no different than taking a HELOC on your house.
Mm-hmm.
Danny, let me ask you this question. Let's say your house, I don't know, I'll just pick a number at random. Let's say it was worth, 500 grand. And let's say that you borrowed against it, you took a HELOC for 200 grand, just for fun.
Yeah.
House is 500,000. You borrowed against it 200. Is your house going to stop appreciating on that 200 grand, or is it going to appreciate in the marketplace just like it would have even if you didn't take the HELOC?
Yeah, definitely keep appreciating.
Right. This is exactly the same thing. You're using the life insurance general fund to borrow from. You're not taking money out of this policy. And that's how it's able to give you the full dividend and interest even on the capital you borrow. Now, the only difference is HELOCs are not guaranteed. This is. Anybody had a HELOC that was pulled back from the banks when markets crashed or businesses weren't doing well? Anybody have a line of credit get lowered or taken away? I know lots of folks who did in the last recession.
So many people, yeah.
And our homes aren't guaranteed to appreciate in value either.
No.
We can go underwater in the home strategy. This is a way to give you a line of credit you can't be denied. All right, so the dividends are exactly the same. One more slide with all these numbers. Here's a guy who, again, takes a loan. He pays it back over a 5-year period. And if you notice there, the cash value is identical whether he borrowed it or not by year 15 when he pays the loan back.
Exactly.
So let me say this one more time, then I promise I'll move on. For those who aren't nerds, this might be, come on back from the water break. But this is the proof. I can't be any more clear, I don't think, that this allows your money to keep on growing in the policy even while you've used it for your business. Where else can I get that advantage?
Nowhere. Okay. Yeah.
Yeah. So the point is, guys, when you control the financial environment where your money lives, you're going to win. When banks control the financial environment where your money lives, they're going to win. Simple as that. Okay, so what are some ways we can use this for our businesses? Well, we've already talked about how this might be a retirement plan alternative. Obviously, we can pay for business equipment without going broke. We can finance our cars, vacations, home repairs, it doesn't have to be a business deal. It can be, right? Danny, you could use this money to go to, Costa Rica or anywhere in the world and have a nice vacation, right?
We've had to borrow money against our old policy for exactly those bullet points. So,
wow, really?
And paid ourselves back. Yes.
Oh, cool. So you can bypass bank financing, and that makes you an advantage over your competitors. Guys, that's super important. Remember I said the average business owner has approximately a third of their income going to banks? So they're almost up to their eyeballs there in debt. Do you think being your own banker would make you more or less competitive?
Way more. way more.
And when the next, not if, but when the next market crash comes, and everyone else is struggling to keep their doors open, are you going to be able to come in and take up market share? You bet.
Absolutely. Yeah.
So a couple other things. You can use this, of course, to start or expand your business. I've used my policies to build out some real estate for our office space here. get some more, square footage here. We used our policy loan to do that. Finance your company-owned vehicles. You can obviously have a company-owned vehicle and use your policy as the auto finance company to yourself. Investment opportunities, this could be done. I mean, I don't always recommend it, but you could use this to invest in the stock market if you really had to, or real estate investments. So here's another quick case study. A guy who's 40 years old, again, funding it at about $3,000 a month. In year 3, he borrows from his policy and buys a $50,000 company car. And he repays the loan, and he repeats that process every 5 years. He's getting himself a new car. And he still has all the cash in his policy by the time he retires, so that he can start drawing on that policy's cash for income. So at age 70, he's got a 6-figure income, but he reports $0 on his tax return. This is how the very wealthy, the ultra high net worth, use their money to their advantage. Where they can still get such low end. Everyone wonders, well, how does Warren Buffett pay less tax than his secretary? Guess what?
Yeah.
He owns not just life insurance policies, he owns whole insurance companies. That's how wealthy he is. Yeah. So if it's good enough for Warren Buffett, it's good enough for us.
Absolutely. Yeah.
So you multiply his income out over 25 years, that's over $3 million of tax-free income, and he still has $340,000 to leave his family when he passes away at age 91. So you add it all up, the income plus the death benefit, that's almost $3.4 million.
Phew.
Yeah.
Yeah.
All right. Well, guys, in the interest of time, I'm going to skip over a few slides just so we can get to some conversation, because I know our time, what do we have, maybe 10, 15 minutes left?
Yeah, I mean, we can run it longer. There's no hard time, but I do like to try to get through people's questions.
Sure. All right. Well, in that case, why don't we kind of talk about final steps and ways we might be able to move forward together. So guys, where is it written that you have got to be enslaved to a bank just to operate your business?
Does it say that anywhere?
Right, yeah. It's not carved into the 10 Commandments.
No.
What risks do you take to run your business? And what risks are your creditors taking on you?
Yeah.
What will be different tomorrow after what you know now? So many people, they take this information and they go back to the lives that they've always lived. There's this great YouTube clip where they put a bunch of fleas in a jar and put a lid on the jar, let it sit there for 3 days, and then after 3 days they take the lid off the jar, and guess what happens?
Fleas stay in there.
They stay in there, yeah. In fact, you could take the jar away you could bust the jar, take them away. The fleas will stay jumping in that shape for the rest of their lives, and when they reproduce, their offspring will stay within the confines of what used to be the jar, even though the jar has been long gone.
Yeah.
So, guys, here's an opportunity to break free from that jar. Anyway, so what would be different tomorrow based on what you know now? So starting a business or saving for the future can be confusing. I'm always happy to give a second opinion on how you're already doing things, good or bad. You'd want to pick a plan that fits your needs. And your real estate, your business is an investment, so you want to diversify. So our work as a financial firm and working with Danny has been a real privilege, Danny. But we work specifically with business owners just like Danny and like all of you to help navigate the waters. I mean, like I said, there's thousands of financial strategies that are out there. I don't expect you guys to be an expert on them. I'll need your help on knowing what to buy on Amazon, because I have no clue. I go on there and there's just an infinite sea of products, and you guys know way more than I do on how to turn that website into a profit center for your life. But I'm very pleased to work with those that would like to. After learning about this strategy, it's not all we do at our firm, but it's one of the key features and concepts that we teach our clients. So if you want, go to our website, lakegrowth.com, and click book a meeting. It'll look something like this. You can go to lakegrowth.com/schedule, and then you click on phone introduction. You can pick either me or one of our other advisors, and you can check your time zone, and it actually shows our booking appointment calendars right there on the web. Okay, so with that, I'll just leave this up. And anybody have any thoughts or questions, feedback, comments?
Yeah. We got some questions. I can kind of go through them and let you answer, and we'll start with the first one. I've heard this one a lot. Why does Dave Ramsey only recommend term insurance?
Yeah, great question.
Yeah.
Yeah, well, I don't know for sure Dave Ramsey personally. I don't know him. I will tell you I cut my teeth, so to speak, financially, listening to his radio show. I still keep envelopes in my wallet. I think the guy does a lot of good to help people in getting out of debt. I think he's way out of date. His talking points are 40 years out of date on whole life insurance.
Yes, they are. I've listened to it specifically about that, knowing what I know now. Yeah. He's not even talking about the same thing. So
that's a great point, Danny.
Yeah.
If in fact, guys, in the interest of keeping this short, go to, if you want to, this shameless plug, I guess, but go to notyouraverageFinancialPodcast.com. On the sidebar there's a bonus episode with Pamela Yellen that talks exactly about that question. How is it that these policies are different than what Dave Ramsey's talking about? So notyouraverageFinancialPodcast.com. A little sidebar there says bonus episode. Listen to that, 20 minutes. It should explain things in detail. But the short answer, maybe it's as simple as saying, hey, is one of his top radio sponsors is Sander Insurance, which is a term insurance company.
Yeah, it's true. I also have a question, and I think you might touch on this, but how could that we earn interest on the money we borrow if we take that money out? How in the world is it still earning interest?
Am I able to draw on this screen?
Let's see.
Maybe.
Let's see. I think.
Are you guys able to see this white screen?
Yeah, we can. Yep.
I'll do this hopefully as quick and as easy as I can, because again, this took me months to figure out. I dug into it. I got so into this, guys. I almost got stuck in what I know is what I now call my season of analysis paralysis.
Yeah.
But I got through it, thank goodness. And this was how I did it. I think I'm a visual learner myself.
Me too.
So
yeah.
If you've got, if you can see this, Danny, let me know if you can't see this.
We can see it. Yeah.
Okay. So let's pretend for a minute you've got $10,000 in savings. Just pretend this block is like a stack of dollar bills. Okay. And let's say we want to go buy a car. Here's our car down here. I'm going to butcher this. Okay, that's supposed to be a car. How do you take money out of a savings account? What do they call it? When you walk into a bank and you ask for a
withdrawal.
Withdrawal. Thank you.
Yeah.
And now we're down and we need to buy a car exactly worth $10,000. So now we've drained our savings account. And one more time, Danny, how much interest are we now earning on this money?
0.
Yes. And all the money that would have grown to had we not bought the car. All right,
Yeah,
so
exactly.
That's pretty clear, right? That could be a brokerage account, it could be a 401k, it could be anything. Once I take money out of something, it's gone. Okay. Now let's talk about how the whole life insurance is different if it's a non-direct recognition company built for this purpose. So many people come to me saying, oh, I've got a whole life policy. Unfortunately, 99% of the policies I've seen are not designed correctly for being your own banker.
Not at all.
So we can talk more about that if you guys have more questions. But let's just do this as quick as I can so I can get to a few more questions. This is a whole life policy. Again, I'm no artist. You get two piles of money. You got your cash value and your death benefit. Let's say your cash value is worth $10,000. Let's say your death benefit is $200,000. Does that make sense so far?
Yes.
Awesome. Now instead, we can, if we wanted to, withdraw money out of our cash value and go buy the car, but that would close the policy down. That would just drain it just like a normal savings. So instead of doing that, I'm going to borrow. And because I have a mutual life insurance policy, I have access to the life insurance general account. We'll call it the pool. I have this big asset that I'm a co-owner in, like a co-op, really.
Yes.
You know, and it's sort of like I own a piece of this big pool up to the limits of my equity in my policy. So I call up insurance company ABCX, whatever, insurance company, and I say I want my money, and they'll look over here. They'll take a loan. They'll loan against my cash value. So they're using it as collateral. They're not actually draining my cash value. It's still in there.
Mm-hmm.
Now they're going to give me a loan for $10,000, and I can go buy my car. Now, who are they, right? If it's a mutual company, they are us. I said that like intentionally grammatically wrong, but they are us. We are the bank.
Yes.
And so, Danny, is this money gone in my cash value, or is it still in there growing for me?
Still in there growing.
Now, they charge an interest rate on loans, and that works out simple. I'll just keep this as brief as I can. Over 4 years, if it took me 4 years to pay the loan back, that would be 1.9% APR. 1.9% APR. It's 5% simple interest. So over a 4-year period, that's 1.9% APR, just to keep the conversation as brief as I can. So that turns out to be $764 of interest I paid the pool. Now, why in the world would I pay an extra $700 to buy my car? That's not good.
Nope.
Now, and a lot of folks are like, well, shoot, if I'm going to get charged interest by the pool, I'll just pay cash for it. And again, I say, well, all right, hold on. What was going on to our $10,000 over the same 4-year period? Where were the profits going? Where did that interest land? That I paid my interest to the pool, and where did that interest end up?
In your cash value.
Yep.
Yep.
So that's doing it about 5.5%. Over the long period of time, call it over the last 60 years, these policies have averaged about 5.5% after expenses, taxes, and everything. 5.5% growth. 5.5% of 10,000 is $550 of growth every year for 4 years, compounded. Mm-hmm. So that turns out to be $2,421 of gains. And we spent, for the privilege of growing our money, $764. So what is that? Help me out, guys. That's about $1,700 or so?
Yes.
So is that better or worse than paying cash?
Oh, wow. Much better. Yeah.
Cool.
You're $1,700 ahead because you borrowed money from yourself.
Yep.
That's pretty amazing.
That's just a car loan. Let's imagine what, bigger amounts would look like. So any other thoughts or feedback or questions, Danny?
Yeah, we do. What happens if you fail to pay back the loan?
Great question.
Great question.
Yeah. So I'll keep this little whiteboard up here for a minute. If I never paid this loan off, one, they're not going to call me. They're not going to bug me. They're not going to ding my credit score.
No.
They're not going to force me to repay and repo the car or whatever. If I took this car loan, if it's really just a policy loan, if I took the policy's money and drove the car off the lot, never paid the loan off, my death benefit would be reduced by my loan balance when I pass away. Whether that's next day or 50 years from now. So if I drove this car off the lot and got hit by a truck or something, my family would get $190,000.
Yes, they just deduct it from your death benefit.
That's how they're, exactly, Danny, yeah. So that's how they're able to offer us these loans with no repayment schedule, because they know they'll get paid, someday.
Exactly. Okay, good questions. Okay, here's a question. How is borrowing from yourself helpful to pay off debt?
That's a very thoughtful question. Yeah, my wife and I have used our policies for this exact purpose. Think about student loans, credit cards.
Mm-hmm.
Maybe you have some of those, or even your mortgage.
Yes.
You can use your policy to buy back your debt.
Yes.
So one by one, you can just start picking off your credit cards, or maybe it's your big student loan. Just take a policy, keep paying your minimums on your debts. Don't default or any of that.
No.
But pack as much money as you comfortably can into something you control, like these policies. And then when you've got enough, let's say you're still lowering your student loans a little bit every month, right? That's coming down slowly.
Mm-hmm.
Pay your minimums, but you're just plowing as much as you can into these policies. So it's a new way of
Yes.
thinking about life insurance. You're instead of trying to spend as little as possible, we're trying to flood that thing full of cash. And as it grows, like, gangbusters, at some point your policy will be worth as much as the debt.
Yep.
And you just borrow from the policy and wipe out your debt to the student loan or whatever. And now you just make those payments to yourself instead. Now you've got growth on your cash value rather than just a bunch of thank you notes from Sally Mae.
So just real quick in layman's terms, say you have a $30,000 student loan and you're paying interest on that loan, maybe it's 5%. And why wouldn't you want to take $30,000 from your policy, pay that loan off, stop paying interest, and pay yourself and earn interest on that $30,000 instead of paying interest and pay yourself back?
Mm-hmm.
That's the point. So that's it's a whole different way of thinking. I know it's outside the mainstream way of thinking, but so is the way we do Amazon here, people. So just you remember that.
That's what I love about it. Yeah, and so if being average means having 10 grand in a 401k and 30 grand in credit card debt, a couple of car loans, a couple of student loans, I don't want to be normal.
Yeah.
I want to be weird in a good way.
Yeah. Let's see. Hey, Tristan, that question would be good with your, if you set up an appointment. That's a really good question, but I think that would be a good question to answer. You'll give you an answer you really like, though. Let's see. Is there a government law backing whole life insurance that has made it sustainable over time?
Great. Okay, yeah. So, we just went through another tax reform deal here in this country, and funny enough, even 401ks were on the chopping block, but life insurance products were not even considered. They weren't going to be touched,
Mm-hmm.
and they never really have gone through major reforms since we even had an IRS. IRS is only 104 years young.
Yes.
Life insurance was grandfathered into the tax code.
Yes.
So again, most congressmen and women have these policies, and that's where they keep the majority of their wealth. They actually have to report their positions, their financial statements when they run for office, and so this is all public record. You can go find this out. Go look up bank-owned life insurance or corporate-owned life insurance. Just type that into Google. Banks alone have hundreds of billions, $146 billion as of last year, wrapped up in these policies.
Yeah.
Why would they do that?
I
But yeah,
wonder
the
why.
government does keep a very far distance from these policies.
Yes.
But we regulate the insurance companies strictly.
Yeah.
They require, by the way, that they have not just 10% on the books and reserve requirements. Banks only have to keep 10% or less on the books. Life insurance companies have to be fully backed in case we all pass away tomorrow. They got to have enough to pay all those claims.
And that's why they've been around so long. I think the company we have is 100 plus years old. So that tells you most of them, correct me if I'm wrong, are in that ballpark.
Yep. At least the ones that. Now, great point, Danny. Yeah, there's probably over 1,000 insurance companies in the country. I would not recommend working with the vast majority of them. Either their balance sheets are a mess, or they've got they've just been around 5 or 10 years. You want to pick companies that are mutually owned, that have been around for over 100 years and have paid dividends straight through the Great Depression.
Yep. So Sandy, answer your question is yes, and Mark could definitely clarify that in a free consultation. Does my loan from Karen was asking, does my loan from and maybe this is a better for later, you can just tell me if it is, my loan from a 403B work the same way?
No, unfortunately it would not, because if let's say for example, you took a loan, you can only take a loan up to 50% of your 403B's value. So if you got 10 grand in there, you can only borrow out 5. They do charge you interest. And if you possibly, maybe you get fired or let go or something, while the loan is still outstanding, then that loan becomes immediately due. Now, when is it a bad time to have to come up with a giant chunk of change?
Yes. Yeah.
when you
Yeah.
just got to let go.
Yeah. Exactly.
So I am seeing lots of introduction appointments coming in on our booking calendar here, guys. So again, head to thelakegrowth.com/schedule. Click on phone introduction. We've reserved about 2 weeks of free slots, as many as we could find. If you have to wait more than 2 weeks, find my other advisors on that website, and you can pick times on their calendars instead, just so we don't have to keep you waiting more than about 2 weeks. Like I said, we did try to block our calendars out for this meeting today, and I don't want to keep you guys waiting. So,
Yeah.
Danny, I know our time is short. Any other final thoughts or questions? Anybody?
Here's a good question. Also for the taxes, would you be paying regular income tax on the money that you paid to the whole life policy each year?
Yeah. Okay, so the money that you're putting into the policy?
Yes.
Yeah, think of this, yes, is the short answer. 95% of the time, you're putting money in after tax.
Yes, your money's already taxed before you even put it in there. So
this is actually a really good point. And there is that 5% of people who do have policies with their business, so there's something we could talk about there, Danny, but policies that could be owned by your business that money goes in and it's a business expense to pay your premium, so that would be deductible. But it's a question of seed or harvest.
yes.
So these policies going in after tax, so you put your money in after you've paid your taxes, just like you pay your taxes on your light bill or your groceries or whatever else. It's just money in your bank account. And then that money is available and grows tax deferred every year, and you have access to even everything in the policy totally tax free. So you pay your taxes on the seed so that your harvest is completely tax free.
Let me say one quick thing. Guys, I know how you guys buy inventory, and I do the same thing. So let's just show you the power of this. Let's say you bought $1,000 of inventory. On your credit card, you earn that 2% on that $1,000. That's tax-free money that you earn, that cash back. It's not taxed yet. But you take your whole life policy and you take $100,000 and pay that credit card off with it. You could do that as well. You can. There's a lot of ways you can double dip with this policy, and so just think about that. Everyone wants to be able to double dip, So you can earn money and then earn money again. So there's a lot of ways you can play this.
Danny, I'd be curious if you have a minute left or two. I know that you've mentioned you have policies, bank on yourself policies like this, exactly like this. How do you hope, and you and I have talked about this already some, but I'd be curious, how do you hope to use your policies for yourself, for your family, for your business?
Right now, what I'm going to do is we've paid off most of our debt, thankfully, because of Amazon. About a year and a half ago, 2 years ago, we paid off pretty much all of our debt. And so what we decided to do with this policy is, look, there's all kinds of different ways you can invest, but there's nothing that's 100% certain. But wait, there's this policy. This is to the dime. I get a contract, just like Mark showed you, on those big sheets with the ages, the life of your policy. That shows you how much exactly you have in that policy and how much you're guaranteed to have. So that peace of mind is, you can't put a price on that. And from now on, when I buy inventory, or I use that money to invest in a development of a new tool that, hey, maybe I'm going to charge for this tool, I'm going to be borrowing money from my policy to do that. Why not earn interest on my own money instead of putting on a credit card or just paying cash, which we know now that's a big no-no. You definitely want to earn interest. I'm going to take that $10,000, let's say, that I would spend on inventory. Instead, I'll put it in the policy. It's going to start earning interest. And then I'm going to take that $10,000 back out to use it to do all these things I'm doing that I'm doing behind the scenes, like tool development, buying inventory, selling for a profit. So essentially, I'm making interest on both ends, on the inventory I bought, and also making interest on the money in my policy. So you got to think about that. Think of that. just compounded your growth tremendously in this business. Everyone knows the power of Amazon and the ROI, the nets you can get, but my goodness, you can take all that money, put in the policy, and you're double dipping, and that's that's the point. That's why this falls so well into what we are doing here. It's just so powerful because we're constantly putting money on credit cards and borrowing money. It's time to borrow money from yourself, and I don't,
Right.
and I think that's just powerful.
Well, Danny, you've said it well, and you're right. I mean, this doesn't change your business model at all, does it? I mean, you're not going to have to forego your business to be able to do this. You're just putting your money has to live somewhere. So
Yep.
it's a question of, well, what are you, where are you going to keep it? And is it going to be to the best of your advantage, or is it going to be working for somebody else, like a bank, for example?
Exactly. There's a couple questions in Facebook. Real quick, Sheila. Yes, I would definitely consider starting a policy for your teens. Yeah, why not? Is that something they can do, Mark?
A teen, like teenagers?
Yeah. Do they have to? What's the age they can
Right.
start?
Well, you guys saw, I think you got a quick picture of my little toddler there. Yeah, she has a policy on her.
There you go.
So
That's awesome.
We're going to use that policy for her college, by the way.
Absolutely.
I mean, imagine how powerful this will be when she gets a college loan from the bank of mom and dad.
Absolutely. Why? It's the greatest gift you could possibly give your children. Yes, not being in debt when they get out of college. So.
Oh yeah. Well, and check this out. This is huge. So let's say she does take a loan from her policy that we own, by the way. She's not quite ready to to bank on herself at her age.
Yeah.
But let's say she does. She has a big loan on her policy after she goes through college. You better believe she's paying that loan off. One, it teaches her the value of an education, the value of a dollar. But Danny, who is she ultimately benefiting as she repays her loan to the policy?
She's benefiting herself, right?
Yep. If she takes,
time.
and what I love about this, I mean, yeah, you're right. That money is hers to spend again for her house or her retirement years. And maybe she doesn't get a job right away, or it's a down economy and she can't find work. We're not going to force her to repay the loans like regular student loans. We'll force her to pay off if she had regular student loans.
Absolutely, yeah.
I've even seen parents do matching programs, right?
Yep.
So the kid pays $1, mom and dad pay $1 to help them get student loan debt free off the policy.
Exactly. Now, Verna, Kate, I see your question on Facebook. Yeah, if 99% of whole life companies are not set up like this, and how you set it up, well, Mark, that's what he does for you. He sets it up, and it has to be set up a specific way to act like these policies do. So that's what Mark is here for. He's going to help walk you through the process and get your policy set up to work exactly like was shown. And he is so detailed. We had a very similar kind of Skype session like this. We shared a screen and went over our contract. We decided amount that we were going to put in every month that we could afford. And so, hey, here's your contract. We went over it. All the questions about that's answered. He structured it, set it up exactly how it needs to be set up to function this way. It doesn't matter what your age is, Jan. You should definitely start this, because that's the beauty of this policy, because it grows so rapidly, and the death benefit alone makes it worth it no matter your age to start with this policy. So don't worry about that. You can just be aggressive with your deposits, or your investment.
So happy to answer any other questions. My schedule, it looks like, is getting full. So if you don't have any, I again don't want to make you wait more than a week or so. So another advisor that I work with very closely, who's an expert at this, probably smarter at it than even I am. Her name is Holly Bach. If you have any interest in working with Holly, I would be working right alongside with her on all the accounts and things that we work with here at Lake Growth. But don't hesitate to set up a time with Holly in the next week or so you guys can learn more and see if this is a good fit for your businesses.
Yeah. So
Oh, great question, John. I wanted to respond to yours. You say, I haven't been able to qualify for life insurance, so I probably couldn't do this. Short answer is you don't have to be the insured to be
mhm.
the owner.
Wow.
So, again, I own a policy on my daughter. Now she's a little kiddo, but you could have a policy on your business partner or your spouse, and
Mhm.
you still own the money in the policy. You borrow from it, pay for it. Income comes out of it just the same. It's simply that you've used someone else to be the insured. Any other thoughts on that, Danny?
Oh, that's actually that's pretty powerful. That's all I can say, John. That's your perfect answer right there. Yeah, Dave, I started my first policy back in um gosh, I'll have to get back to you on that. Maybe the first time we had one was 2007, I believe. So that was quite a while ago. Syed asked, when recession comes, the value of the currency devalues overall. So how whole life insurance helps in this scenario?
What was that?
Syed asked, when obviously sometimes when there's a recession, the value of the currency devalues overall, and so how whole life insurance helps in this scenario. I think
Right.
it's
Yeah. Well, there's all sorts of economic scenarios that we've gone through over the last 160 years. So, again, the short answer, I mean, we could talk about hyperinflation, we could talk about deflation,
yeah.
decline in the dollar. I mean, how much, I don't want to bore people to tears here, but how much time do we have left, Danny? I want to keep an eye on
They're
those time.
always open ended. I would say we
All right.
maybe just wrap up in like 9 minutes. I'll put us at
All right.
one. Yeah.
Perfect. Yeah. So just real briefly there, every economic scenario is going to be different. But what I found is, in the midst of deflation, you want a steady stream of income.
Yes.
You want, when there's fewer dollars floating in the economy, you're locked in, guaranteed, growing for you every year. Policy will be an ever increasing value to you in the midst of a deflationary economy. In the midst of an inflationary economy, a lot of folks are worried about all this money that the Federal Reserve has floated into our economy over the last 10 years or
Mm-hmm.
so, quantitative easing and all that.
Yep.
So as we look at the increased money supply and the decreasing value of a single dollar, right? Because if I have a dollar in my hand and there's a money machine over there printing off money to the tune of trillions of dollars a year, that
Yes.
my single dollar in my hand is going to be worth less and less. So it's also important to realize that these policies are really backed by fixed income investments, corporate bonds, that sort of thing. So if interest rates rise, the internal mechanics of the policy means more dividends for all of us. So
Mm-hmm.
the higher the interest rate, go back to the late 70s, early 80s when we had
Oh man.
stagflation. Wild, right, Danny? Do you
Yeah. My
who,
dad talks about that. Yeah, that's pretty crazy.
anybody have like a memory of mortgages back then were 18%, 20%
Oh man.
mortgages?
Yeah.
So
Yeah.
whole life insurance during those years was doing about 16, 18, 19%.
That's the beauty of this policy. Yep. Yeah.
I don't know if that answered the question, but
I think it
anyway,
did.
just look through history and see how these policies have worked
Mm-hmm.
with various scenarios, because they've been around long enough for us to backtest them.
Let's see. I see a couple questions about how much money. Look, what Mark will do, or whoever it is at Lake Growth, will talk to you. Well, what do you want to achieve with this policy? And they'll tailor the policy to your needs. Like, how much money can you put into the policy? How much do you? Where do you want to be? What do you want to use this policy for? And so the policy will be tailored. So there is no two people will put the same amount of money into the policy. It's going to be different for everyone. So it's going to depend on a lot of factors.
Exactly.
And I think we maybe can fit this in. Dave asked, can Mark explain how this is different than the other 99% of the whole life policies?
Yeah. So Dave, yeah, you've got one more shameless plug, I guess. But again, if you want to hear more to this question, go to notyouraverageFinancialPodcast.com,
Mm-hmm.
or just find it on iTunes or Android, Google Play, or whatever. There's several episodes where we get into this in more detail, but let's see. In particular, the whole life policies we're talking about have kind of a long laundry list of requirements we have to ask and look for. So, again, there's over 1,000 insurance companies out there. I'm not going to pick just any of them. Here's a short list of some of the things that we need these policies to do in order to be your own banker. And it's sort of like your iPhone or your smartphone. If it doesn't have all the working parts inside it, it won't work. The good news is for us users, all we have to do is push this button and the thing takes a picture.
Yep.
Or checks the email or whatever. So you don't have to mechanically design this yourself. That's what me and our advisors are here for. But short answer, Dave, is you want it to be a mutual life insurance company, meaning it's owned by policyholders, not by shareholders on Wall Street. That's
exactly.
Second, you want it to be dividend paying. A lot of whole life insurance out there today is not dividend paying. You aren't reaping the profits of the company if it's not a mutual insurance company. So that means your dividends are going to some dude who bought the company down on Wall Street, not to you. So you want it to be a mutual company. You want it to be dividend paying policies. You want it to have a specific rider called a paid up additions rider. Paid up additions rider. That's a rider, and options on a car is, riders are just simply like options on a car. A rider might be, there might be thousands of riders on various policies and products out there in the country. So you want to find one that has the paid up additions rider that changes your policy's contract and allows you, the owner of the policy, to just pack way more money than you normally could into the policy.
Yes.
At a lot more efficient rate. So old-fashioned whole life is sort of like a big battleship that really takes a long time to get going. What we're building is just a monster speedboat that can just get revved up quickly. So you want paid up additions rider is kind of like the nitrous oxide in the tank.
Exactly. One other quick question. We'll make this our last question. And this is the cool thing, Dave. I'll let Mark answer it. But how long? I'm sorry. Where'd it go? Oh shoot! I lost this. Does it take a while for your cash value to be available? How quickly can you withdraw your cash value?
Yeah. Okay, so I'll tell a quick story on that one. Had a lady earlier this year. Let's see, was it this year? No, it was last year now, 2017, last spring. She dumped in about $150,000 into a policy. Again, numbers don't, your numbers will be different. She had 150. She dumped it all in because she saw a condo she wanted to buy for investment purposes, rental.
Yes.
So she dumped in the money on a Friday. And then the next week, middle of the next week, she requested the loan from the policy, and she had the money in her account about 3 or 4 days later by that condo. So that's how fast you can do it.
Yep.
Most of the time, it's within the first month you can borrow from it. You don't have to wait years and years.
No. That's the beauty of this, everyone. So definitely set up your consultation with them and get all your questions answered. But yeah, so hopefully I'm all excited again about this now. So we currently have 2 policies. So I'll try to, if it's a real basic question, I'll answer it, but I am not Mark. So I don't want to ever quote anything wrong. So make sure you set up a time to talk to Mark or one of his other associates, and you'll get all your questions answered. And Pam was asking, what's the difference between a phone intro and a financial analysis? I guess that's on your website.
Right. Yeah. So great question, Pam. Just to briefly answer. So I really just want to get your front burner questions answered as quick as I can. So 15 minutes, we'll see if we're a good fit for each other. After 10 or 15 minutes, 25 minutes or so for a phone call just to get your initial questions answered. Then we would have a more in-depth conversation. That's where I'd ask you a few more details about your situation, what you're trying to do, what you're trying to accomplish. All of that's completely confidential, obviously. I don't charge for that consultation. But that's what we would really need to go through or talk through before I would really build anything that was in your best interest. So as a certified financial planner, I got to stick to that code.
Yes.
That we're doing this in your best interest. And that means I got to ask you a few questions. It's sort of like a financial wellness checkup.
Yes.
That's after we have our phone intro meeting. So yeah, wonderful question, Pam.
Great question. Yes. So guys, get your thing set up. This is 2018 time. Try to rethink your whole business. And this is a big piece of that. And it's time to think about your future. And we're just going to continue adding value like this to the group. So I think this is going to be so huge. You're going to have such a huge edge on your competition long term if you have your policy and your finances set up this way. I can tell you that from personal experience.
Danny, it's
they're not.
Pleasure.
Yeah. So yep, it's been a pleasure. I appreciate you, Mark. And thanks everyone for paying attention. Lots of good questions, and get your time set up, and look forward to see as the year goes on, how everyone uses their policy.
Awesome. Thank you again, everybody, and have a great weekend.
You too. Talk soon, everyone. Bye.